There are certain moments in financial markets that quietly shape the direction of wealth for years to come. Most people only recognize their importance after the opportunity has already passed. June 20 could become one of those defining moments, not because of a single announcement or headline, but because several major developments are coming together at exactly the same time. When these events overlap, they have the potential to influence the movement of global capital on a scale that few individual investors fully appreciate. At first glance, the financial news appears to focus on familiar topics. Conversations revolve around high-profile public offerings, the rapid expansion of artificial intelligence, and speculation surrounding future interest rate decisions. While those stories attract the most attention, they only reveal part of what is actually happening beneath the surface. Behind the headlines, much larger structural shifts are taking place, and those shifts could influence investment performance for years rather than weeks. Understanding these deeper market forces is becoming increasingly important because financial markets are often driven by expectations long before official decisions are announced. By the time a major event dominates the news cycle, large institutional investors have frequently spent weeks or even months adjusting their positions. That difference in timing is one of the biggest advantages professional money managers possess over the average investor. In today's video, we're going to examine the mechanics behind these developments, explain why so many institutions have been paying close attention, and discuss why this period could represent an important turning point for global markets. Whether you invest in stocks, exchange-traded funds, retirement accounts, or simply want to better understand the financial landscape, knowing what is happening behind the scenes can help you make more informed decisions instead of reacting after markets have already moved. One of the biggest reasons for the recent uncertainty has received surprisingly little public attention. For several weeks, the leadership transition at the United States Federal Reserve created an unusual period in which investors received very little official policy guidance. During times like these, markets often become increasingly focused on expectations, speculation, and subtle signals rather than clear communication from policymakers. Former Federal Reserve Chair Jerome Powell delivered his final press conference near the end of April, and his term concluded in mid-May. Shortly afterward, Kevin Warsh was confirmed by the Senate and officially assumed the role of chairman. However, his first meeting leading the Federal Open Market Committee was scheduled for the middle of June. This created a relatively rare transition period between administrations at one of the world's most influential financial institutions. The Federal Reserve plays a central role in the global economy. Its decisions regarding interest rates, monetary policy, and financial conditions influence borrowing costs, investment decisions, government bond yields, corporate financing, and consumer spending not only in the United States, but across international markets. Because of that influence, even brief periods with limited forward guidance naturally attract the attention of institutional investors around the world. Without regular policy updates or new signals from Federal Reserve leadership, professional investors were left to interpret incoming economic data on their own. Every inflation report, employment release, manufacturing survey, and consumer spending figure became increasingly significant because each data point offered clues about the direction future monetary policy might take. While many retail investors remain focused on daily market headlines or the excitement surrounding artificial intelligence companies, institutional investors were evaluating a much broader picture. Large asset managers, pension funds, hedge funds, and global investment firms continuously monitor changes in economic conditions, interest rate expectations, and capital flows. Rather than reacting to news after it breaks, they often adjust portfolios gradually as probabilities begin to shift. This doesn't necessarily mean that a dramatic market move is guaranteed. Financial markets are influenced by countless variables, and no single event can determine future performance with certainty. However, periods when multiple economic and policy developments occur simultaneously often create meaningful changes in investor behavior. Understanding those changes before they become obvious can provide valuable context for anyone trying to navigate today's financial environment. As we continue, we'll explore why so many professionals are paying close attention to this period, what factors they believe could reshape capital allocation over the coming months, and how these developments may affect different asset classes in the years ahead. This brings us to another principle that consistently separates experienced investors from those who spend years reacting to every headline that appears on their screens. While daily market movements often receive the most attention, disciplined investors typically direct far more of their focus toward the broader economic environment. They understand that short-term price fluctuations can be influenced by emotion, speculation, breaking news, and temporary shifts in sentiment. But long-term investment performance is much more closely connected to the underlying direction of the economy. Every trading day produces thousands of news stories. One headline may suggest that markets are entering a period of rapid growth, while another predicts an economic slowdown just a few hours later. Social media amplifies these messages even further, creating an environment where every small movement is presented as if it represents a major turning point. For many individual investors, this constant stream of information creates pressure to act immediately. Buying after a strong rally or selling during a temporary decline often feels logical in the moment because emotions become closely tied to short-term market behavior. Professional investors approach the situation differently. Instead of asking what happened today, they usually ask what larger forces are developing over the next several quarters or even the next several years. That shift in perspective changes almost every investment decision they make. Rather than allowing temporary volatility to dictate their strategy, they evaluate whether the fundamental conditions supporting economic growth are improving, weakening, or remaining relatively stable. Adults. Macroeconomic trends provide a framework for understanding those larger forces. Inflation, employment, consumer spending, manufacturing activity, productivity growth, business investment, and monetary policy all contribute to the environment in which companies operate. These variables influence corporate earnings, borrowing costs, consumer confidence, and business expansion. While they rarely create dramatic changes overnight, they gradually shape the direction of financial markets over extended periods. Interest rates offer one of the clearest examples. A small daily move in the stock market may attract significant media attention, but the broader path of interest rates affects nearly every asset class. Higher borrowing costs can influence corporate expansion plans, mortgage affordability, consumer spending, and business investment. Lower rates may encourage borrowing, increase liquidity, and improve financial conditions for many sectors of the economy. Because these effects develop over time, disciplined investors monitor the trend rather than becoming distracted by isolated market reactions. Inflation follows a similar pattern. A single monthly inflation report may cause markets to move sharply in one direction, but experienced investors rarely base long-term decisions on one data release alone. Instead, they look for consistent patterns developing across multiple reports. They evaluate whether inflation appears to be accelerating, stabilizing, or gradually slowing because those trends influence future monetary policy expectations. Understanding the direction matters far more than reacting emotionally to one unexpected number. Employment data also provides valuable insight into economic momentum. Strong labor markets generally support consumer spending because people with stable incomes are more likely to purchase goods and services. At the same time, unusually tight labor markets may contribute to wage pressures that influence inflation. Rather than viewing employment statistics in isolation, disciplined investors consider how labor conditions interact with inflation, business activity, and central bank policy to form a broader economic picture. Consumer spending represents another important indicator because household consumption accounts for a significant share of economic activity in many developed economies. If consumers continue spending confidently, businesses often experience stronger revenues, which may support earnings growth. However, if spending begins to slow for an extended period, companies across multiple industries may face weaker demand. Investors monitoring these trends gain insight into the overall health of the economy long before quarterly earnings reports fully reflect changing conditions. Business investment deserves equal attention. Companies invest in new equipment, technology, research, facilities, and employees when they expect future demand to justify those expenditures. Rising capital investment often signals confidence in long-term economic growth, while declining investment may indicate increasing caution among business leaders. These decisions are rarely based on daily stock price movements. Instead, they reflect management teams evaluating broader economic conditions over several years. Financial markets frequently experience short-term volatility even when long-term economic trends remain largely unchanged. A geopolitical development, an unexpected corporate announcement, or a temporary shift in investor sentiment can move prices significantly within hours. Yet many of these events have little lasting impact on the fundamental drivers of economic growth. Disciplined investors recognize this distinction and avoid confusing temporary market noise with meaningful structural change. This perspective also reduces the temptation to constantly adjust investment portfolios. Frequent buying and selling based on daily news often increases transaction costs, encourages emotional decision-making, and makes it more difficult to maintain a consistent long-term strategy. Investors who understand macroeconomic cycles are generally more comfortable allowing their investments time to reflect the broader trends they have identified rather than expecting immediate results after every market move. Another advantage comes from understanding that financial markets typically anticipate future conditions rather than simply reflecting current ones. Asset prices often begin adjusting months before economic data confirms a new trend. Markets attempt to estimate where inflation, interest rates, corporate earnings, and economic growth are likely to move next. Investors focused only on today's headlines may find themselves reacting after much of the adjustment has already occurred. Institutional investors devote significant resources to analyzing these relationships. Teams of economists, markets research analysts continuously evaluate economic indicators, policy developments, demographic changes, productivity trends, and global capital flows. Their objective is not to predict every short-term fluctuation, but to understand the larger environment influencing investment returns over time. While individual investors may not have access to the same resources, they can adopt the same mindset by prioritizing long-term trends instead of becoming consumed by daily market commentary. Global developments further reinforce the importance of macroeconomic analysis. Modern financial markets are highly interconnected, meaning changes in one major economy often influence investment conditions elsewhere. Central bank decisions, trade activity, commodity prices, currency movements, and international capital flows interact in complex ways. Understanding these broader relationships provides context that cannot be captured by focusing exclusively on individual company headlines or single-day market movements. Technology has also transformed the speed at which information reaches investors. News now travels instantly across financial markets, creating rapid price reactions within seconds. While this improves market efficiency, it also increases the volume of short-term noise competing for investors' attention. Every economic release, analyst comment, or political statement can trigger immediate volatility, even if the long-term implications remain relatively limited. Disciplined investors recognize that not every headline requires an investment decision. Patience becomes one of the most valuable qualities in this environment. Economic cycles develop gradually, monetary policy operates with delayed effects, and corporate earnings typically respond over multiple quarters rather than days. Investors who appreciate these timelines are often better positioned to evaluate whether temporary market reactions truly reflect meaningful changes in long-term fundamentals. Risk management also becomes more effective when viewed through a macroeconomic lens. Rather than attempting to avoid every short-term decline, disciplined investors focus on understanding how different economic environments affect various asset classes. They recognize that diversification, portfolio balance, and consistent investment discipline often contribute more to long-term success than accurately predicting every market headline. Perhaps most importantly, macroeconomic thinking encourages investors to separate emotion from analysis. Fear and excitement are natural response to rapidly changing markets, but decisions driven primarily by emotion rarely produce consistent results over long investment horizons. By concentrating on broader economic forces, investors create a more structured framework for evaluating opportunities and risks, allowing them to make decisions based on evidence, long-term expectations, and disciplined analysis instead